Steve Letwin, thanks so much for joining me.
My pleasure.
I want you to talk about what's happening at Iamgold. There's some very exciting things coming down the pipeline right now. What's happening there?
Well, let me go back in time a little bit. Probably two major challenges that Iamgold had is the cost structure and the life of mine. We had very short life reserves. I would say 8-year life reserves, which in the industry considered to be quite short. A cost structure that was running at around $1,300, $1,400 an ounce, all in sustaining costs. In a business where gold prices had fallen from almost $2,000 an ounce down towards $1,000, we became very unliked. Where our share price fell precipitously as the gold price fell because our margin fell. So we had two major challenges to take on. One, get that cost structure down. Two, extend our reserve life. Now, we've been able to do that, and I give full credit to our management team, our operations people for that. What they've been able to do, frankly, is go right to the site with productivity improvements and with a lot of incentives at the site, get our people to start thinking about making money again. And that has brought our cost structure down to about $1,000 all in sustaining costs. So a dramatic improvement. So the market's rewarded us for that. The other thing that we've done, which we talked about briefly coming here, is that we moved our strategy to what I call a short cycle capacity strategy. And what I mean by that is that we started to focus on finding more gold in and around our infrastructure, as opposed to spending a lot of money trying to find large deposits in other countries or in the same country. And what that did for us, frankly, is it moved us significantly towards adding reserves, because we've had some great success, and also helping us reduce costs yet again. So it was a double help. We reduced costs, we're bringing in higher grade ore, soft rock, into our mill that we didn't have before, and we're extending the life of the infrastructure that we've already paid for. The best example I can give, and it's been written about a lot, is our discovery south of our mill in Rosabelle called Saramacca. We believe there could be up to 2 million ounces in a very small defined area where we've been drilling. So the good news is huge amount of ore that's very good in terms of its grade, 2 to 3 grams an ounce. Also very soft rock oriented. So all of a sudden we're going to be able to move this soft rock, higher grade ore into our mill, reduce our cost structure even more, and extend the life of Rosabelle probably another 10 years. This is a mine that 4 years ago had a life expectancy of 2018, next year. We're now looking at a 2030 mine life with all these extra resources. I think that's why we're the top performer year to date. That's why we were the top performer last year. And I believe we're going to see some significant improvement in both our cost structure and our reserves going forward. What we're seeing at Rosabelle, we're seeing in Burkina Faso with our Essakane mine. That philosophy of short cycle capacity is really paying dividends. We haven't forgotten about long cycle. Cote, our Japanese partners, have come into that. So we have a real good combination, long cycle, short cycle, and it's showing in our results.
So I want to follow up on what you've just talked about there. You have an announcement coming up on July 27th.
Right.
What are you planning on announcing on that date?
Well, what we're hoping to do is educate the market about the great results that we expect to see from the concession drilling that we've done at Rosabelle. So put Saramacca to the side. We've been in contact with analysts. We've been giving the markets updates about the fact that with improved drilling, with our saddle deposits, which are deposits that exist between our pits, we have a very good feeling about increasing the resource at Rosabelle, even without Saramacca. So what we're hoping to communicate to the market towards the end of July is an update of that reserve and resource, which we've promised for some time. And I think and believe that the market's going to react quite favorably to the fact that without even considering Saramacca, this large discovery we've made south of our mill, this mine has got a life of its own without help. So add Saramacca to that, and as I say, you have got a brand new mine. A mine that had been forecast to literally end its life as we know it, 2018, is now going to be moved out in time over 10 years. And the cost structure, which is extremely important, is going to come down significantly because the infrastructure has already been paid for, the grade is going to improve, and the rock is going to be softer than what we've been mining for the last 2 years. So put all that together, and the economics of our Rosabelle operation are going to improve dramatically.
You just said you brought costs down by almost $200 overall per ounce. In terms of what's happening with this new discovery that you're going to be announcing here very soon, it seems to me like you've really turned a corner with the company. As you say, you're the top performing gold stock,
right,
you know, in the market year to date.
Right.
What do you think you guys are doing right that other people are doing wrong or just haven't quite figured out?
I think we started about 4 years ago realizing that cash is king, which most people know already, and that in order to be one of the top performers, our cost structure has to be competitive and our reserve life has to be competitive. And I would say we didn't sell off a lot of gold to do that. What we did was we looked into the company itself and said, what can we do from a manpower standpoint, from a human resource standpoint, and what can we do with the assets we currently have? And that was a huge change for us. In 2012, we spent $160 million in exploration. And 90% of that was on long-term capacity. Today, we're spending 40 to 50 million, and 80% of it is on short cycle capacity.